The headlines insist everything is fine. Stock markets hover near record highs. Unemployment numbers look healthy. Official language speaks of recovery, resilience. And yet, beneath those statistics, unease has settled into everyday life. People who did everything they were told to do feel off balance. Rent feels heavier, mortgages feel out of reach. A single unexpected bill can turn confidence into anxiety. This is the tension most households live with now. The economy looks strong from a distance, but fragile up close. Prosperity appears on charts, not in checking accounts. Growth exists, but it doesn't translate into breathing room. Stability has become conditional, dependent on nothing going wrong. One job loss, one medical issue, one rent increase, and the margin disappears. What makes this moment especially disorienting is that it lacks a clear crisis. There is no collapse, no dramatic shock, no obvious villain. Life continues. Shelves are stocked. Apps still work. Yet the sense of forward motion, the belief that effort reliably leads to security, has quietly weakened. This is not a temporary slump or a cyclical downturn. It is something structural, slow, and deeply unsettling. And if this feeling is real, not imagined, the next question first becomes unavoidable. What did the American middle class used to be before this erosion began? The post-war American middle class was not an accident of culture or attitude. It was a deliberately constructed economic system. Wages rose alongside productivity, meaning when the economy grew, households felt it directly. One income could support a family, buy a home, and still leave room for saving. Housing was abundant, credit restrained, and expectations were linear: work steadily, advance gradually, retire securely. This structure mattered because it created predictability. Families could plan. Businesses could rely on stable consumers. Democracy benefited from a broad population that felt invested rather than cornered. The middle class absorbed shocks, sustained demand, and anchored social trust. It was the quiet machinery beneath American confidence. Today, nostalgia often reduces this era to symbols: suburban homes, factory jobs, or pension checks. But those were outcomes, not causes. The real foundation was alignment between labor, capital, and policy, designed to distribute growth widely enough to maintain cohesion. Once that alignment weakens, the lifestyle fades quickly. And once we understand how intentional this system once was, it becomes easier to see where and how. The first cracks began forming, quietly, invisibly, long before anyone thought something was truly broken structurally. The numbers tell a story that headlines carefully avoid. Productivity in the United States has risen steadily for decades, yet real wages for the median worker flattened long ago. Output increased. Pay did not. That gap is the first shock, because it reveals that growth continued while distribution quietly changed. Housing data sharpens the picture. Home prices detached from incomes, turning shelter into a speculative asset rather than a stable cost. Rent followed the same path. Healthcare and education costs climbed faster than wages year after year, transforming necessities into long-term financial risks instead of temporary expenses. Savings reveal the emotional core of the data. A shrinking share of households can absorb even a minor emergency without borrowing. Retirement balances look larger on paper, but are increasingly concentrated at the top. The category labeled middle class keeps narrowing, not because people are falling dramatically, but because fewer remain securely inside it. This is why the data feels terrifying. It shows erosion, not collapse. The economy isn't failing at the edges, it's thinning at the center. And while the numbers tell us what is happening, they immediately raise a more uncomfortable question. Why does this divergence keep accelerating instead of correcting itself? These trends reshape power, stability, trust, and long-term expectations. Inflation is often described as a single number, but its effects are deeply uneven. Asset inflation lifts those who own homes, stocks, or businesses, while cost inflation presses down on those who live on wages. The same economic force creates comfort at the top and anxiety in the middle. Housing illustrates this divide. Rising prices look like wealth on balance sheets, yet translate into higher rents, larger mortgages, and permanent entry barriers for new buyers. Insurance premiums, childcare costs, and healthcare deductibles rise quietly, rarely making headlines, but steadily shrinking monthly margins. Debt completes the squeeze. Higher interest rates reward savers with assets, while punishing households dependent on credit to smooth everyday life. Servicing costs climb, flexibility disappears, and risk shifts downward. The middle class becomes the shock absorber, expected to adapt without relief. What makes this dynamic powerful is its invisibility. No law needs to pass, no vote needs to be taken. Inflation reallocates security automatically, rewarding ownership and penalizing dependency. It feels natural, even inevitable, but inflation alone did not dismantle the middle class. It simply revealed a deeper structure, one where money flows upward by design, and stability depends less on work than on position within the system. This is the context in which every economic stress compounds. When an economy becomes financialized, its priorities quietly change. Growth is no longer measured by how many people earn more, but by how efficiently capital multiplies. Asset prices become signals of health, even when wages stagnate. Debt expansion replaces income growth as the engine of consumption, and stability depends on liquidity, not security. In this system, labor is a cost to be minimized, not a foundation to be strengthened. Policy rewards balance sheets over paychecks. Central banks stabilize markets first, households later. Risk is socialized downward, while gains remain concentrated upward. The middle class is not eliminated, it is repurposed, expected to absorb volatility without political or institutional protection. This is the financialization trap. Economic growth continues, but participation narrows. Productivity benefits capital holders disproportionately, while earners experience uncertainty disguised as flexibility. Jobs exist, yet feel temporary. Benefits shrink, mobility slows. The economy works, but not for those inside it. Crucially, this shift feels technical, not political. Incentives are embedded in interest rates, asset valuations, and credit channels, far removed from daily experience. That distance blunts resistance. People adapt individually rather than challenge collectively. But none of this emerged organically. These structures were built, reinforced, and globalized over decades. To understand why the middle class became the shock absorber of modern capitalism, we have to widen the lens beyond domestic policy. This didn't happen by accident, it followed a logic. Globalization offered a bargain, consumers received cheaper goods, lower headline inflation, and constant availability. In return, wage pressure was quietly exported. Jobs became mobile. Supply chains stretched across borders, and bargaining power shifted away from domestic labor toward globally mobile capital. For a time, the trade-off felt worthwhile. Lower prices masked stagnant incomes. Credit filled gaps. The middle class maintained living standards without noticing that ladders were thinning. Stability appeared intact, even as resilience weakened. Offshoring didn't simply remove jobs, it reshaped careers. Fewer roles offered training, progression, or long-term security. Work became fragmented, outsourced, or temporary. Meanwhile, global capital gained flexibility. Investment could exit faster than communities could adapt. This imbalance had geopolitical roots. Open markets prioritized efficiency over redundancy. Nations competed to attract capital by lowering labor costs and protections. The system rewarded speed, scale, and cost compression, not durability. Over time, this structure normalized fragility. Households adjusted expectations downward while risks accumulated upward. The benefits of globalization remained visible on shelves, but the costs embedded themselves in paychecks, savings, and futures. Once a system runs smoothly long enough, it stops being questioned. Only under stress do its fault lines surface. And when they do, the realization is unsettling. Comfort delayed the reckoning, but it never removed it. Past recoveries followed a familiar script. Recessions cleared excess, growth returned, wages caught up, and stability slowly rebuilt. This moment does not follow that pattern. Household debt is higher. Asset prices matter more. Demographics are heavier. Policy tools are constrained by the very systems they now protect. The economy still functions, but its margin for error has shrunk. Higher interest rates strain borrowers before they cool prices. Lower rates inflate assets faster than incomes. Governments face aging populations, rising obligations, and limited fiscal space. Each solution solves one problem by worsening another. This is why this period feels different, not because collapse is imminent, but because reversal is difficult. The system resists change. Adjustments arrive unevenly, protecting those already insulated while exposing those who are not. For the middle class, this translates into narrowing options, fewer paths to ownership, less tolerance for disruption, greater dependence on conditions remaining stable. The economy rewards positioning over effort, endurance over advancement. None of this means the system is broken. It means it has matured into a form that prioritizes continuity over mobility. The question is no longer whether growth will return, but who it will reach and at what cost going forward today. The American middle class is not disappearing overnight. It is being rewritten by incentives that quietly shifted away from stability toward efficiency, liquidity, and asset dependence. The drama is not collapse, but transformation. For decades, economic health has been measured by markets, output, and aggregate growth. Those indicators can improve even as household security erodes. When stability is no longer the objective, insecurity becomes a feature rather than a flaw. This is why panic misses the point. The system is still functioning, goods move, capital flows, institutions persist. What has changed is who absorbs risk and who is protected from it. The middle class increasingly bears volatility, while being told the economy is strong. Understanding this reframes the debate. The question is not whether the middle class can return to a past version of itself. It is whether future systems will reward participation or merely tolerate it. Economic systems rarely collapse when people notice problems. They change when costs accumulate beyond denial. The quiet erosion of stability eventually forces adaptation, not through outrage, but through necessity. That cost still grows.